employers added 303,000 jobs. That was much more than economists have been looking for. But is this enough to get the Fed to start cutting rates? Let's welcome in Michael Gapen, BofA Securities Head of U.S. Economics. Michael, it is good to see you. So let's just start with that jobs report, stronger than expected. Michael, give us your take. What were your big takeaways?
Well, certainly, as you mentioned, major upside surprise to growth in employment, adding 300,000 jobs on the month. But the key here for the outlook for the Fed is, does it create overheating effects? And I think the answer is still no. So for me, the most important figure today was really that average hourly earnings number rising 0.3 on the month and 4.1% year on year. That's a little above where the Fed would say is consistent with 2% inflation outcomes, but it's the lowest pace of wage growth on a year-on-year basis that we've seen in the past 3 to 4 years. So I think it fits that supply side narrative they've been telling. A rebound in the labor force gives a strong employment growth. It keeps the unemployment rate low, but it hasn't changed their view that disinflation should continue.
So, Michael, at the same time, there is a little bit of a narrative emerging from a certain cohort that says maybe we won't see any rate cuts this year, right? Torsten Slok over at Apollo is one of those folks. Michelle Bowman bringing it up as at least a possibility today. Do you give any credence to those kinds of views?
We do, absolutely. And I think the inflation data is probably most important in terms of deciding whether the Fed can cut or when it can cut. But that activity data and the data we saw in the labor market today suggests, well, even if they do start, maybe the pace will be slower, or ultimately the terminal rate will be higher, right? So there's kind of three components to this: the when to start, how fast to go, and when to end. And I would look at the labor market data saying it's still reasonable for the Fed to consider cuts this year, but maybe the pace will be slower. So we're not quite at the point where we're thinking no cuts this year, but certainly a slower pace or a higher terminal is in the cards.
And Michael, as you think about kind of the trajectory of inflation from here, what does it look like?
Well, I think that the key for us next week, we do look for core CPI to rise by only 0.2 on the month. So we're essentially looking for whether we get indication that the January and February data is more of a one-off. It's consistent with the so-called January effect, where many firms increase their prices at the beginning of the year, but it's a one-off story, not a change in the trend. So for us, opening the door to Fed cuts is about further disinflation. We think core PCE will fall to around 2.6% year on year in the fourth quarter. So it'll be a more shallow disinflation process from here, but we think it's one that will continue and be enough to get the Fed started with rate cuts. We think in June, but perhaps it comes later.
Michael, we've seen gasoline prices that have been creeping up here. And of course, inflation expectations on the part of consumers are important then sort of circling back into inflation. So how much of a concern is that?
Yeah, so I would say it's a headwind, it's a mild headwind to our outlook for disinflation. So not only gasoline and oil prices, but other commodity prices have been moving higher. Our commodity strategists have been revising higher their outlook for many important and key commodity prices. The Fed doesn't really control those, but it is something that would give you, upward pressure on headline inflation. It would be a drag on consumer spending and likely slow the disinflation process. So right now we'd say it's not enough to change our view, but it's a risk and it's something we're watching.
Michael, I'm also interested to get to sort of just your general grade on the overall economy now, right, Michael? And why don't you think Americans feel better about that economy?
Yeah, our overall view, I think, is pretty constructive and optimistic. We agree with the supply side narrative that the Fed has embraced most recently, that what we're really seeing is a rebound in the labor force. It's increasing the capacity of the economy to grow without generating overheating effects, and that's really benefiting everybody. So it ends up, what starts out with a rebound in the labor force ends up with a story about stronger employment, stronger income growth, and greater spending. I think maybe why it hasn't percolated through to consumers, there's a number of reasons. But I think one is simply the difference between the price level and the rate of inflation. What people like me talk about is, oh, inflation is slowing. That doesn't mean the price level is falling, it just means it's rising at a slower rate. So I think households are still adjusting to what has been a big level shift upward in the price level over the past few years. So, the data says we should be feeling good about things on a macro level, but I certainly understand why, it's difficult at the household level to digest the higher prices we've seen.
Michael, maybe one of the other things affecting sentiment this year in particular is that there's a presidential election coming up. And I'm curious, not just how you're thinking about how it's affecting consumer sentiment, but also, if you are saying there's a possibility the Fed could start to cut later than forecast, we start getting close to the election. And so I know the Fed says they're not political, but you have to wonder if that starts to factor into their decision making.
Yeah, my view is that, I used to work there, so maybe I'm a homer and I'm biased, but I do think that the Fed tries to make these decisions independent of the election cycle. So I think that ultimately their credibility is best served by conducting policy the right way. And if they think cuts are justified, they should do it. If they think delaying rate cuts is justified, they should do that. So in my view, I don't think the election timing is really a major influence on what they're deciding.
And Michael, we've had strategists on the show this week, and some of them questioned, why should the Fed cut at all? The economy is strong, labor market's solid, consumers hanging in there. Why rock the boat? What's your response to that?
Yeah, it's a good question, and certainly one that I receive frequently. And I would say, at least from what the Fed is saying and what policymakers are saying is, right now it's the U.S. economy is pretty interest rate insensitive, and the economy is growing well despite higher policy rates. Their fear would be that if inflation keeps trending lower, as it has been, then you're getting a de facto tightening of the policy stance, because the nominal policy rate is elevated, inflation's falling, your real policy rate is tightening. So I think their worry would be, if we stay at this level for too long, then we could reverse some of the labor market gains that we've had, and we don't need to do that to bring inflation down. So I think that's probably the main reason the Fed would say that, why they're looking to cut rates, even though the broader economy looks just fine.
Michael, thank you so much for helping us kick off the show today. Appreciate it.
Thank you.